Sanjay Dutt, Director with Quantum Securities, he joins us live from his Delhi office. Sanjay, morning. Thank you for joining us. Sanjay, markets are sitting at a record high, but the market mood is reminding me of a bear market low.
That's absolutely correct, Nikunj, and rightfully so, because if you look at the broader market, one hasn't seen participation across the board, both in terms of investors and in terms of stocks across the board. We just about 100 stocks which are driving the index up in rotation. That's the only reason why we've seen Sensex at the new highs or whatever that is.
So do you think somewhere it's the overall pessimism and lack of participation which will continue to drive this market up? As of now, 9 out of 10 strategists are bearish on India, and just about everyone on the street is convinced that this rally has limited lifeline or timeline.
Nikunj, if you look at it, in the last 3 to 4 years, in the last 5 years when we've been in a bear market, we may have had a CAGR, growth in earnings of 15-20%. We've had reasonably good GDP growth, so therefore the Sensex or the Nifty at new highs has no meaning because we should be much higher. Number one, you correctly said that there is a lot of pessimism amongst the analysts, and I believe rightly so, because there are still a lot of structural issues, there's still a lot of macro issues, some ground realities that need correction to get a sustainable move up. I think the move ahead would be positive, but it would be a very cumbersome climb up, as far as the market peaks are concerned. And that's primarily because of the fact that we've got strong headwinds domestically, we've got uncertainty abroad. So it's not going to be easy. So therefore the market movement will continue to be narrow, restricted to these 40-50 stocks, because there isn't much to choose from when one needs to invest, and one is compelled to invest in emerging markets if one is a global fund manager.
Sanjay, I was just coming to the point. Will the move from here also be as concentrated as the last 2 months have been, wherein the strength remains with just about 10 odd names from the Nifty?
Aisha, there would be, the proverbial rotation that will go on. Those 10 names would change. There would be 10 different set of names amongst the 50 stocks as far as the Nifty is concerned. But the issue is that amongst the 50, 20 odd stocks have got a structural problem in terms of, forex exposures, bloated debt, on-ground growth issues. I think till those are not addressed, we won't get a sustainable rise up. We will again be in a very narrow market because structural issues still are not being solved. I'm repeating this again and again because, bloated debt, need to sort out the equity, growth to come back, sustainable growth to come back, liquidity to come into the system, and cost of money coming down. These are very key elements for a sustainable bull market that will spread across the board and not just be concentrating on 20 odd stock or 30 stocks.
What is your advice? Don't blow the trumpets, don't get excited. Yes, markets are sitting at a record high, but that is not the true story. The true story is that Indian economy has not recovered. We are not out of the woods.
Okay, coming out to the Indian economy, I think we are at the lows when we won't really, stoop any further in terms of the numbers, in terms of fundamentals. But to say that we are going to be gung-ho about everything across the board in the next 2-3 years, I don't think so. So therefore, the opportunities in the market would be very stock-specific based, very company-specific. One would have to go down both in mid-caps as well as in large caps. So making money in the market is not going to be easy over the next 2-3 years. Money would be made, like money has been made in select stocks in the last 3, 4, 5 years, even though we had a very severe bear market. And I think a similar thing is going to be maintained over the next 2 to 3 years till we are not really out of the woods completely in terms of major macro and ground level issues that are plaguing the companies.
Sajay, what's your sense on what does one do with the banking pact now? Because it's been a little bit of an iffy ride, again, a dichotomy between PSUs and private banking lot.
See, I think from a longer term standpoint, that's about a year or two ahead. This is a very good time to accumulate select banks because I think you've seen a peak of the NPA cycle. More or less, I think interest rates also are done with, as one can read from the RBI governor's statement, because growth is really in the sub, in the below 5% range. So therefore, I think tightening will go off. Lending has been reasonably robust for the banks. If NPAs start to taper off or start to remain even at the current levels, definitely the banking sector starts looking good. And if we do expect some sort of recovery over the next 6-12 months, it's the banking sector which will be the biggest beneficiary in terms of stock prices. So I would be a buyer in the banking stocks on a bad day, on any reasonably good decline, and particularly in the PSU banking space, which are, I think, very attractively valued on a selective basis.
Do you like the telecom space, and if that be the case, would it be a trade for you or an investment bet?
In the telecom space, I just like one or two stocks. Probably an idea still looks good on a bad day when one sees it a little lower from the current levels. But of course, the space has still got some issues to resolve in terms of balance sheet problems, debt problems, policy issues. Policy issues to quite an extent are getting resolved. So I would stick with an idea in case I need to invest and I do want to have some exposure to the telecom space.
So Sanjay, what is a prudent course of strategy in this kind of a market where defensives are sitting at a record high and cyclicals are sitting at a multi-year low? Should one still focus on defensives because the economic pain is not over, or now it's time to reverse and the basic portfolio approach should be that economy will recover and defensives will underperform and cyclicals will outperform?
I think it's the latter, what you just said, Nikunj, that this is the time to start taking exposures to cyclicals and the traditional hard asset stocks while being a little underweight on technology and other defensive sectors. Because in the next 6 to 12 months, I see a good uptake in the cyclicals, both in terms of some of the infrastructure stocks as well as things like steel, banking, and those kind of conventional places where one doesn't want to be at this point of time, obviously. I think that's the place where money would be made in the next 12 to 18 months. Very difficult to game what's going to happen in the next 2 to 3 months, keeping in mind the, monetary policy and the fiscal issues. But a little far ahead, a little further ahead, 1.5 to 2 years, I think it's time to reposition now. So just wanted to add something very interesting I noticed yesterday. Sorry, carry on. You were saying something?
Please tell me. I always love to hear some interesting observations from you.
Yeah, something interesting. We were just sitting in the office with my colleague and we were looking at stuff. I think ITC trades something like closer to a 30 price earning multiple. Its FMCG business still continues to lose money or struggle. But BAT, its US parent, not a US parent, but its major equity holder, trades at something like 16 or 17 times. So one can make out the stark difference between the valuations that are being given and how so much of money has moved into defensives and why that's becoming an overcrowded trade. These kind of disconnects cannot remain. Yes, I know that the growth is there in India. Margins may be better here, but you can't have that much of a multiple difference between a BAT and an ITC when the FMCG business is still losing a lot of money here or continues to struggle. So therefore, the defensives here are stressed, I think. And of course, lever last 2-3 days back, we did hear talking about and trying to guide down in a manner.
What's the view then on metals, Sanjay, considering names like a JSPL have wiped up almost 46% of their market cap? Tata Steel as well has declined a good 24% year to date. But off late, you do see some trading moves coming in.
I'm glad you brought up this sector, Aisha, because I'm very optimistic on this, and particularly stocks like JSPL for various other reasons which we know in the press. It's been beaten down, and it's the price is where we see it right now, beaten down 50-60% in the last year or so. I would, if I had to bet my money, I would really aggressively bet my money on these kind of companies, which have an excellent balance sheet, don't have too much debt, have totally rehashed the management lately, I think, and of course, I'm pretty optimistic on steel over the next 12-18 months.
Sanjay, but you're investing dangerously. For those who are making an assumption that we have an economic bottom in place, the worst is behind us, it's too early, isn't it? Because what could really pour cold water on your bullish assumption is tapering.
I think that story is played out, Nikunj, and the RBI governor was also pretty clear on it. Of course, one would say that he would want to paint a brighter picture than what actually it is. But frankly, I think that tapering bogey is played out to quite an extent, and we really don't know what Janet Yellen, the new Fed governor, Fed chairman, is going to come out and what kind of stance he's going to take. And as for if you read the Fed statement that came out last night after 2 days of deliberations, it's very clear they're not going to be in a great hurry to start tapering because the U.S. still does have problems to live with. We're once again going to come up with the budget impasse in February next year in the U.S. So I think the tapering bogey is played out. It's for the emerging markets. Currencies there have stabilized, would remain this way. RBI has done a great job in the last 2 to 3 months in terms of swap lines, in terms of various other, FCNR action it's taken. And I don't think that's really going to